Good morning, everybody. I'm Stephen Harris from Family Wealth Report. Welcome to this webinar. This is a webinar from the Family Wealth Report Virtual FinTech Summit, and it's on ESG. ESG and impact. ESG and impact, can technology help tell fact and fiction? Today's moderator is Doug Fritz. Doug is from F2 Strategy. He's joined by a very able and talented panel. They are Tim Ferguson from Tilt Investments, Jay Littman from Ethic Investing, Peter Bruce Clark, Impact Capital, and Daryl Roxburgh from Beta Risk. I'm going to leave you now in Doug's very capable hands to take you through this incredibly important topic of ESG and impact investing. Doug, over to you.
Thanks, Stephen, very much. Thanks for having me, and thanks to our panelists for joining. I'm going to ask our moderator to publish a quick poll for those all in attendance. It's a great way for us to begin our conversation, and a great way for you as participants to begin the conversation with a bit of engagement. Our poll question, our leading poll question today is: how do you believe the global impact and market volatility have impacted and will impact investor appetite for more impact in ESG-weighted portfolios? Do you believe it will significantly decrease, modestly decrease, remain unchanged, very similar to today and in the past? Will it moderately increase the appetite for advisors and clients to construct ESG-weighted portfolios, or will it significantly increase the appetite of investors and advisors to construct and manage ESG-weighted portfolios? Go ahead and answer those questions quickly on your screen. Just go ahead and click the button. And we'll close that poll down here in just a few seconds and launch into our conversation today. All right, let's go ahead and close that poll, and we'll review the answers. Outstanding. Thank you all for participating. Looks like the increase modestly has won the day, with about 44% of respondents on the call indicating that the current pandemic and market volatility will increase modestly the appetite for investors to include or request ESG and impact weighted themes in their portfolios. Thank you very much. So first of all, in today's conversation, what I'd like to do, and I think it would be very helpful, is if our panelists just briefly characterize themselves, how they see the current state of play on impact investing, on due diligence, the monitoring, reporting, technology, sort of their side. And Jay Littman, if you wouldn't mind going first, just quick intro and your perspectives, please.
Of course, thank you, Doug. So I'm Jay Littman, co-founder of Ethic Investing. We essentially create cleaner index investments that replicate the index investments that large families already have exposure to. And we use the technology platform to help investors define their values, get transparency into their existing indexes, and then understand the impact that their portfolio is having once that they've actually invested in the cleaner direct index that we create. And one of the nice things about the position that we have is that we actually sit right at the forefront of what's going on right now, in that we see everything real time. We see demand, we see asset flows as the volatility is actually hit, because we're in the passive equity markets, right? So we see things, we see assets flow as money moves through the volatility. And we can say from our own personal experience that we have seen a pretty dramatic increase in interest in ESG, because ESG is more data. Right? It's about more having information in the companies you're investing in. And if you're in an index, as you go through mass volatility after 10 years of the market going, generally up, you would welcome that information, that data about which companies might be performing on the kinds of values that you prioritize from an ESG capacity. So that's our experience, and happy to chat further. But yeah, thank you, Doug.
Awesome. And Peter, how about you?
Yes, so I'm Peter. I'm at Social Impact Capital. I'm a partner there. We're an early stage social impact and environment focused venture capital firm. So we're doing seed and Series A, sort of direct investments in startups. We've invested in actually Jay's competitor, OpenInvest. And so we love what Jay works on because it's so important in the same way that open investors sort of important in the same way of sort of lending insight and also enabling investors to construct the portfolios that they want to create in alignment with their values. For us, what we've noticed is that there's been an acceleration in demand from LPs for products like ourselves. Particularly, actually, even on the banking side, I've seen it from AllianceBernstein, UBS, Chris Kaminka at Lombard Odier, seen it from a variety of different people. And I think that there is an emerging client demand for these kinds of products. It's not just, I think, a function of the pandemic and these sort of social circumstances. I think that the other thing that we're seeing, particularly more obviously in the public markets, for instance, with BlackRock's performance with its traditional investments versus its ESG portfolios, for our side, we've seen an acceleration of performance. So, I think there are lots of managers like ourselves that are demonstrating pretty significant internal rates of return on our investments even during this time.
Awesome. Thank you. Tim, can you go next, please?
Certainly. Thank you, Doug. I'm Tim Ferguson. I'm the co-founder of Tilt Investments, which is a mission-aligned investment platform that works with asset owners who are interested in separately managed accounts. So I don't view it as a product per se, who are interested in aligning their capital with what we call their boundary condition, which means their purpose, their mission. And we work across multi-capitals, so financial, environmental, civic, and human. And I think that in terms of what we're seeing is that I'm hopeful that there will be increased demand for the type of product that we provide or capability that we provide, but actually believe that most of the interest at the moment is on the ESG side in the public markets, where we're seeing a lot of discussion shift from the E, particularly to the S, the social, and as well to more emphasis on the governance as well.
Fantastic. Thanks, Tim. And Daryl.
Doug, good morning, everybody. I'm Daryl Roxburgh, Global Head and President of Beta Risk. We come from a slightly different focus in that we're a software company providing risk, portfolio analytics, and management tools to the family wealth and private wealth industries. As such, I work across a broad number of companies, from large family offices through to international private banks. What we're seeing is there is a pull for ESG from clients. Clients are looking for it, they're seeking it out. There is a drive for ESG from the investment teams within organizations because they believe the factors behind ESG are incredibly relevant in terms of selecting investments. And then the dreaded C word, compliance, especially in the European market, is coming to the fore, where the regulator is already publishing a taxonomy for defining environmental impact, requiring companies to report on this, and then from the investment industry's perspective to publish how they adhere to it. So I think client-driven, investment-driven, and regulatory-driven, it's got to be on the increase. And actually, I personally think it's a very good thing as well.
Yeah, thank you very much. Outstanding, guys. So I'm going to launch into some questions we've got just about how this theme really got to where it is, how we decipher and sort through some of the marketing hype versus what's actually needed under the hood to do this well, where there are pitfalls and traps, possibly where some of the current focus may have shifted. I think we've heard that before from many folks that maybe it's moving, away from or sort of gaining additional focus outside of the E into the S and G and other impacts. But so it's still a really fast growing early stage concept. If you think about what we're talking about today, it's a concept in investing in client sentiment and client demand. It's likely been going on for hundreds and hundreds of years. But in our current wealth management family office paradigm, it is still a fairly nascent space. And the taxonomy, the sort of categorization taxonomy for impact investing it's still a work in progress. I mean, Daryl mentioned it. We've got European regs coming. There's been UN standards that have been out there and sort of directions and goals that people can apply to. But I personally worry that growth without great uniform taxonomy just confuses things and lets people cast doubt on the data that's coming out. And so with this work in progress, and methodologies for measuring the non-financial returns, how can any institution be ready for standards that rapidly evolve and still continue to deliver and follow through on their client messages? So I don't know, Jay, do you have a perspective on that?
Yeah, it's a very good question, because we work across the country, or across the US, and we do see how this conversation plays in different areas in a large country with a really kind of wide array of client bases and families. And one of the things is that if you do present this as a sustainable investment or as an ESG investment to a family that is not necessarily open to the conversation, they can feel almost as though it's semi-threatening, or that it's you trying to propose a value set upon them. And when they don't feel as though they have had a voice in defining that value set, then it's harder to get everyone on the train to transition enough assets to actually have the impact that we're all trying to collectively have here. And so for us, it's actually about trying to help those families, those individuals, those investors to be a part of defining the value set. So instead of saying it's E and S and G, helping them understand how it connects to their love of nature, how it connects to their love of human rights, and then say, well, that actually does connect to the E component, the S component, the component of just valuing justice, for example. And then the other side of that is ensuring that you have enough data about the underlying companies that actually make up the portfolio, such that you can inform the construction of that portfolio to accurately reflect that value set, so that when you have a conversation about what they value, you then give them a portfolio that is actually an accurate representation of the values that you've connected on. And then, because you have that data, you can determine which companies are justifiably in the portfolio versus out. Whereas the uniformity of an agreed upon terminology or taxonomy is so difficult, because there's still so much different vernacular being used, that it really is difficult to say there's one agreed upon approach that everyone is going to agree upon, because everyone here, I mean, myself included, is coming to this with different levels of education and preconceptions about what this all means. And so starting from scratch, we feel, is the most appropriate way to get people to transition assets appropriately.
Great. Tim, you want to go next?
Sure. So I think that your point, Doug, around the taxonomy is an important one. I would say it's about definitions too. So I think we tend to meld everything together. So ESG is the same as impact investing. I'm not so sure that that's actually the case. And I think that until we have a nomenclature that is broadly agreed, I mean, rather like the SDGs provided a framework for talking in general about impact, or about social challenges, social issues, I think we need to have the same thing around investing. So for example, I don't use impact investing because I think that it's a very narrow definition, and I think it's often misunderstood. I think Jay's absolutely right that at the end of the day, particularly with high net worth families, family offices, with principals, they're talking about their purpose, what we describe as their boundary condition, and effectively working with them in a consultative sense and as a partner is really, really important. This is new. It is a tiny market, the impact investing market. It's 500 billion. And to your point, Doug, it's rather similar to where the hedge fund market was in the late 90s. It was a 100 billion market going to $1 trillion. Today it's 4 or 5 trillion. So I'm optimistic that that will change, but believe that we collectively have a lot of work to do to actually define what we mean and to ensure that as more and more players come onto the field, to use the sporting analogy, that they do understand that there's a need to combine both investment skill, which is really important, with what I think of as community and economic development knowledge. I think particularly in the private markets, and there are very few people who span both the social enterprise world, the community world, with the investment world. And I think that presents a challenge for all of us in terms of getting both the advisors as well as the principals themselves to commit more capital to this space.
Awesome. And Peter, from an investment side, when you think about this question is really about how can firms be nimble to adapt or prepare to adapt for changing regs. And so when you're thinking about investing in firms that are doing this, like, does that play a role at all, like nimbleness and ability to move quickly?
Yes, absolutely. And I think I would just love to go back to what Tim just said and follow on from what he was saying, because I actually disagree. I actually really like the distinction between both ESG and impact. As an asset manager, I think it's really important. I've also been a consultant to family offices, the Donnelly family in Chicago, which is actually originally how I got into all of impact investing. And then, on the other side, with sovereign wealth funds and pension funds and superannuation funds, who think about sort of the world in a very different way. And for me, and for us at Social Impact Capital, we very much think that impact investing is a very useful way in which you're thinking about the way in which different asset classes and different asset managers, depending on asset class, right, are deploying an impact strategy. It's very asset class specific. It doesn't look the same in venture as it does in real estate. It's very sort of narrow. It is kind of narrowly defined in that respect. But for us, I really think that impact investing is more on the private side and ESG is more on the public side. And I also believe that ESG in practice, when you are designing portfolios, if you're a public investor, is actually a retroactive strategy. What we do, which is very, very different, is we invest in businesses where the driver of the business model is the social environmental impact. So it's internal to the mode of production. So what we're doing is we're actually creating a completely different kind of reality set based on the way in which these businesses are disrupting either pre-existing industries or completely creating like blue ocean type industries.
Awesome. That's great. It's a great perspective. Daryl, from a data perspective, this has got to be your backyard, right? Like quickly moving data, where is it coming from? Give us a sense of, how do people prepare for this? Especially since you think about they're in the process of building not just proposals on how to manage portfolios this way, but actual reports and updates on their client portfolios, impact themes. If those themes and categories and rules and regs around them change so quickly, like how do people adjust?
I think just listening to Tim and Peter, there's some really good points here, Doug, before I come back to that very quickly. The naming, let's call it naming as opposed to taxonomy or anything else, is critical here. Because when we talk about impact, I agree with both of you. Impact is you are directing funds towards ventures that are going to make a socially positive impact, however you define social. ESG is about understanding environmental, social, and governance factors at various levels of granularity that are reported by companies in terms of their operation, how they work. And those may either appeal to the client's utility of doing good through investing in certain ways, or they may appeal from an investment perspective in that you are avoiding potential environmental risks, reputational risks, social risks, and so on. And then there's the third one, which used to be called the SIN stocks and now tends to be referred to as the SIN products because there is much more granular data available around that. And for the poor investor, at the family end, they're lucky. They've got Peter, they've got Jay, they've got Tim, they talk to them and they can spend time. But for the average investor with the average advisor, this is a huge amount of complex data to try and assimilate. And there, I think I used the term sustainability until I got a call from one of my clients' compliance directors saying, you can't say that S word anymore. It's got regulatory meaning. So what we need to do as an industry is just say, hey, ESG, it bundles everything together. And within ESG, you have the ESG factors, you have impact investing, you have socially responsible investing, socially conscious investing, and products somewhere over there on the right-hand side. So that's a lot to bring together. And what we've looked at is how we, capture in the mass market, so the high, ultra high net worth, as opposed to the family, individual client preferences, and then provide the advisor with the tools to analyze a portfolio rapidly against those, identify where there are conflicts in stocks against those preferences, and measure the change as they go through time in terms of their exposures against the client preferences. And I think, you know, the title of today is Can Tech Help? I don't think you can do this without technology. And it's not a case of doing it on the back of you probably don't say a cigarette packet anymore, or even a beer mat. Beer mats have gone with social distancing. Back of an envelope, there we go. It's not a case of doing it on the back of an envelope or even an Excel spreadsheet. When you're dealing with probably minimum 40 different factors, and going deeper on a sort of a large portfolio, and then across thousands of clients, you need to be looking at this from a technical perspective, a quantitative perspective, but at the same time, never losing the detail through averaging the scores up, always having that insight into the underlying detail. And Doug, you'll probably get my green salad speech later.
Heard that green salad speech. Thanks, guys. I think I want to take it. I mean, it's maybe annoying, but I want to take it. Continue to go deeper here, because I think we're talking about data moving and the ability to sort through data for clients. Talk about the ESG impacts individually with clients so that they truly understand where their current portfolio and hypothetical portfolio you may move to is going to better align with their future. That all requires data. That all requires good data, data that's changing, data that can adapt to new taxonomies and new inputs, adapt to client preferences quickly. So what are the ingredients in, like, what does that mean, good data? Like, what is good? For instance, in the performance reporting space, data is everything. Poor performance data equals poor performance reporting. You can't rely on it. Is there anything there from that the performance reporting industry that we see really as something that can be correlated to the ESG industry, and other lessons that we can learn as we're making this more of a real concept with our clients today? I don't know, Daryl, do you want to take that one to begin with?
Yeah, I think in talking to our client firms, the one thing I've said to them is that they have to own the data. And we work with a number of the major data providers. And I've got personal views in terms of the quality of the data, the way the data is gathered, the way the data is aggregated up. But an investment firm must understand that for themselves, because this is fundamental investment data. You're making decisions on the back of it, whether that's a decision about the suitability of a portfolio for the client or whether it's an investment decision. And so you, at the end of the day, need to be able to stand up and say, I went to firm X, they have this process of assessing and capturing the data, and I've then applied it, and because of this, I understand why this is this, and this is this. I think that's the first thing. Second thing, detail. Always look at detailed data. Don't just say this company has an E score or an ESG score of 52. It's meaningless. Yeah. Because within that 52, it may be a 5 at one end and a 99 at the other, and you've no idea where those 5s and 99s are. So you need to own the data, you need to understand the data, and you need to drill down and work at data detail. And that costs money. So this isn't a free ride for anybody. And if you get data that's really cheap, you want to ask why.
Yeah, good point. I mean, before I ask everybody else, just having worked with our clients on this process, I think no one would disagree with you that good data is critical to the outcome. I think that we've seen so many firms struggle to get good data and to be able to afford it, because and just personally shocking to me is that in the industry focused on doing better for the world, a lot of times the data vendors that may be listening that we would go to charge a ton for this data. And so I don't know if anybody's got secret sauce around there for our audience on how to get great data at a lower cost, but I think that's been a significant limiter to what we've seen in the industry. But Jay, do you have a perspective on that in terms of just lessons we can learn from performance and data that we can apply to ESG reporting?
Well, Daryl's exactly right in that to look at the rating or the score at the top level is a little bit misleading. And I think that in this industry, everyone talks, actually generally not always positively about the data providers, but the reality is they do an incredible job. They actually do an amazing job looking at hundreds, if not thousands, of underlying factors as it pertains to each of these pillars of E and S and G. And then they present a score, which is their subjective interpretation of that underlying data. But when you're working with a large family and you show them that score, and then they start to dig deeper and they understand, well, why did they make that decision? Well, you're looking at a score, which is a reductive way to essentially collate all of that information, right? So in order to make informed investment decisions, especially for very high net worth or ultra net worth families, you have to enable them to define their value set and apply it to the raw underlying data. Now, the way that we do that is that we look at multiple data providers and the raw underlying data. And we have a system that allows us to inform the portfolio analytics, construction, and reporting. So you're not seeing analytics or transparency from one provider and then getting a portfolio from another provider and then seeing reporting from a third provider, because that's three different narratives and three different things you're focusing upon. So by creating consistency and using the data to plug into each of those, you can say, well, I prioritize deforestation, carbon intensity, water intensity, human labor rights abuses. And I'm seeing which companies are not aligned with that in my portfolio, building a portfolio that aligns. But then when you're reporting, you're seeing the cumulative carbon saved. You're seeing the labor human rights infractions that have been diminished as a result. And then the nice thing about that when you work with these families is that you get to compound that over time, right? You invested in that portfolio 3 years ago. What is the collective carbon saved over that time as it is an equivalent to the portfolio? And most importantly, I think for this conversation is, and Darryl made a really good point, saying your carbon score has gone from 51 to 58. I have no idea what that means, right? I'm dyslexic as it is. I don't know what that means. But if you were to say, hey, you've actually saved 175,000 miles of driving in the last year, then you connect it to the emotive, language that we all speak. And you're like, wow, that's actually really impressive. And so having that consistency of data throughout the process and then giving people equivalence in a language that humans actually understand, I think is a really powerful thing. I mean, that's what we do. And it seems to get people excited. Tells a story, right?
Let's I want to riff off that comment, Jay, about just the taking the data and going to the more emotive side, like really connecting with people. When I think about technology, especially, and God knows where we're going to be in like 5 more years, but right now, the digital connection that our clients have with their portfolio, with their advisor, because we're all stuck at home and no one can go to meet with their advisor. They can't go into their own office. So many of our clients are consuming whatever digital engagement and technology are provided by their advisor and by their family office. And they're absolutely, as people haven't seen the data, like this upwelling of demand for more technology, more engagement. Now, I think that I can't remember who the quote was, probably multiple people, that we've seen a decade's worth of demand for digital skip forward. We've skipped forward a decade in 3 months in terms of client expectations and demands and needs. So technology itself, we're gonna ask a big broad question because we've got both technology firms, investment firms, and private equity venture firms on the phone. So does tech, and this, I mean the biggest term of technology, have a broader role in helping convince investors of the impact of impact, right? That there is a material personal connection with their portfolio and the companies that they're invested in, and helping to get more traction. Like, does tech have a place to get more traction? And I'm going to season that question with, how the heck do you know as an investor whether it's just a screen, which could have a negative impact on your return and risk, versus something much more delicately constructed, properly constructed off of good data? So kind of a dual part question, and I'll open it to the panel. I want a melee here of people answering this question. I don't know, or maybe Peter, actually. I think I would love to hear from you from an investment perspective and companies looking for, like, where do you guys fall on this?
Yeah, I mean, well, Zoom is now a really amazing stock to have. It wasn't prior to COVID, but now it is. And I think that COVID and moments of, social and environmental volatility, which frankly we're now going into this era of, that actually decentralization, tech-enabled existence, even drone delivery, for instance, is going to be a really big thing that people double down on. What I've noticed actually in my Zoom meetings with other LPs, families, or actually I was talking to the head of Cambridge Associates about this, is that the beautiful thing about Zoom is I think that I've got to learn about people and people have got to learn about me a lot more than you would if you're in person and you've got like the sort of veneer of professionality when, in fact, you could be on a Zoom call and a bell rings or your child like runs behind and, people actually have to talk about the fact that that just happened. And, in that way, it's been really, I think, really positive. I think it's changed the way in which people think that we can and cannot do business, right? I think there's an old guard that really wants to come and meet you in person to ensure that you're real. But, going back to that veneer, when we're sort of sat across like this, like you get to know exactly who you're doing business with. And I think that fits both within the entrepreneurial context as it does with asset allocators with funds. So I think there's a real shift in perspective about how we can do business. Yeah.
Awesome. Tim, what about you?
So I just want to go back to something that Daryl said, which is around owning the data. And I think technology has a huge part to play, but I think that the current providers are holding it close. And working, we've got to a point with a particular client where they've actually asked us to build a portfolio reporting system for them, and they're removing their current mainstream investment consultant who historically has done that. And the reason they're doing that, and they've been doing this for over a decade, so they're not new to the party, so to speak, mission-aligned investing, is that it's been very, very hard to drill down on the data that they provide. So I think that as an industry, tech can absolutely be really, really helpful. And I would argue that it's a prerequisite, to Peter's point, that he was making, that things can change and can shift. And for an old dude to say that, I'm agreeing with the way that the world is actually going in that sense. But I think that we have to be consistent. I think we have to be transparent. And I think that we have to recognize, that every client is going to want to dig down at a different level. So there's going to be a challenge as to how that gets provided in a way that's cost effective from an intermediary point of view, whether you're a fund manager, whether you're a data provider, whether you're a systems provider, or whatever it happens to be. But I do think tech is critical. I would say that just like the distinction between ESG and impact investing, and I'm actually really comfortable with that distinction. I agree with Peter on that, is that it's the same in the data world. We're at the beginning. People are really good on financial data. We have 100 years of data, right? We're trying to apply the same techniques to the other, what I call capitals. And that is actually really hard to do. When I dig on people and ask them, show me your investment process, it's kind of squishy, with very, very few exceptions. So I think that that's normal. That's what we would expect when any new asset class, investment approach, whatever you call it, is developed.
Can I just add to that, Doug, too, because there is a structural challenge. I think the work with what Jay does, for instance, is amazing. And there are now companies on the public side and the ESG side that I think have really stepped up in what they can do and how they can help investors navigate this moment. Is really difficult on the private side. You actually have to just build it yourself, and that's what we're doing. We'd love to have Carter. Carter is a sort of like fund administration tool to have a impact component, but then it goes back to the data and where is the data coming from, right? So for us, at a very fundamental level, what we do is we legally inscribe the impact into our companies. So the reporting comes up from our companies in a very collaborative process where we help them come up with the metrics, but it's very much a negotiation. And then because we're talking about the reality creation component, which is what venture capital is when you're doing proper venture capital, it's actually something that the metric that you originally came up with as an illegal requirement might not make sense at Series A. So the idea of how do you over time, refine what that metric is and ensure that you really are capturing the accurate data and information underlying the sort of production is super important. And so what we've done in addition to that is at any stage in our financing, we can bring in third parties like, Tideline or any of these sort of consultants to validate the validity of the metric that's being used. But it's always going to be in state and flux. I don't think there's like the sort of, it's never going to be an origination or like a, like some fundamental truth. It's never going to be like that. It's always going to be something that is a refining process over time. And we're constantly looking for opportunities where we can do things more automated on the private side in terms of the reporting, because it is such a challenge, particularly when you're an emerging manager.
Great points. Daryl, from your side, how does tech help to move this along?
I think, as I said earlier, Doug, it gives you the ability to bring a lot of data to bear on a portfolio very rapidly, and then to be able to assimilate that information and make decisions on it. So the way that we look at it in terms of a portfolio, let's say it's a portfolio made up of individual stocks, just for simplicity. Each of those stocks will have maybe 30 factors associated with it. Each of those factors we rank into something we call goodness bandings, for want of a better term in the project. And the goodness rate ranks from bad through average to excellent. And what we then display back is for each of the factors, your exposure in terms of weight ascribed to each of the goodness bandings. And that way instantly you can look across multiple factors in a visualization and see, well, actually, have I got more than half in better than average approaching this? And then the next step is to click and you get a dial which just displays to you by goodness bandings companies for each of those factors. So you can immediately drill down and say, I've got these 5 stocks that are either rated as 0 or 1, the worst possible level against human rights. Now, I can now see which stocks those are. I can make a decision as to looking against the other factors associated with them. Should I be holding them? Or actually, they're in my conflict dial. I should be getting rid of them because the client has said, I don't want anybody less than average in terms of this. So it's taking very granular data. And at the request of our clients, we boil that back up to an E plus an S plus a G. And you can compare that E plus S plus G to, say, the S&P 500. You can compare their carbon to the S&P. But again, on carbon, we look at it from the bad to the good and rank the companies by different metrics and say, well, which companies in my portfolio are substandard by either my or by my client's definition. And that we started from a portfolio risk perspective. So we were looking at all the fundamentals around portfolio construction, and then we integrated that with the ESG and impact and SRI and product overlay, so that you're getting those 2 sets of metrics all together in one place. And we had a head of a UK charity. He's the investment director. He's got, I don't know, 500 million, sort of $600 million. He came in and looked at this and he said, there's only one thing missing. You've got yield impact, you've got risk impact, you've got asset allocation impact, and you've got the factor impacts, and you've got macro factor impacts, and you've got style impacts. What would it have done to my return? So we gave him the last 12 months return and he was happy. So it's about bringing that all together. This isn't ESG on its own. This isn't risk on its own. This isn't portfolio construction on its own. It is all of those things brought together in one place.
Awesome. Thank you for that, Daryl. Yep, go ahead, Jay.
I might, the role of technology in accelerating the transition of assets to impact, right? That's what we're all here trying to do, right? We're trying to move as many assets towards sustainable impact companies or products or investment strategies as possible. Now, the thing that we see technology enabling is that what Daryl's just described is actually really difficult. Everything that they do is really, really hard. But if you can tell the story about it, then the assets will flow, right? So what we see is that you speak to pretty much any large family and you say, hey, what are your values? What do you care about? All right, let's actually put them down on paper. Let's craft a mission statement. Would you like to invest? Would you like to invest along with these values? Yes, 100%. Right. So, okay. So what's on the product side? Right, on the product side, we've got incredible investments like Peter's product. We've got incredible strategies like Tim's, right? The performance is there. Through the volatility of the last 2 months, all the ESG strategies that were underway, oil and airlines, have just done really well, right? So the performance is there. So you've got the demand side, families want this. Then you've got the supply side, Tim, Peter's products, right? You've got the supply, the intermediaries in the middle, right? You've got the wealth advisor, you've got the institutional consultant, you've got the investment committee, you've got the CIO, right? For a large family, if you can empower the intermediary to tell the story, assets will flow. That's what technology does, right? It enables them to have the performance, so they can say, hey, it's non-concessionary. All right, the performance conversation's off the table, right? We're good. Hey, impact, all right? We know how much impact we're going to have. Fantastic. We can communicate that every year that we sit down. We know how much impact we're going to have. And then in the future, we can use the technology to maintain essentially that we are in the boundaries of the trying to impact that we're trying to have, right? Environmental, social, human, governance. So that's what technology is for us. It's to empower the intermediary to tell the story so that you can connect the supply and demand, which we know is huge, right? Because that's what the data tells us. Everyone wants sustainable investments. The performance is actually great, but where is the $1 trillion of flow? That's what technology allows. And that's what we try and focus on.
I think, Jay, that's a very quick anecdote. You'll remember the climate change protests in London that brought the city to a standstill.
Yeah.
Our office is right by Bank, where the center of the protest was. And I was stopped by this rather smart middle-aged lady on my way to the office in the morning. And she said, I'm protesting. I said, what are you protesting about? Climate change. I said, good. And she said, well, what are you doing? I said, I'm trying to provide the tools to firms so $2 trillion of client money can be directed towards climate change positively. And, that's our evangelical sort of mission, is to provide those tools to help people do this, to meet those client needs.
Yeah.
We're really quite passionate about this one.
Yeah. So part of my, provocateur personality, that's all good. But what I want to go into one level deeper is that if you're a firm, if I'm an investor and I'm already working with either an asset manager that's providing tilted products to ESG, or with an advisor or a multifamily office or a family office that understands it and is already incorporating those themes, I get those already because I actually picked who I want to work with and who I want to have manage my money and my investments, in part or in total, because of their ability to do this. It's the vast majority of the rest of the industry that may be ESG curious and just, I've got a couple clients that may want to do this, but I don't really know that I fully understand it as an advisor, and I'm not really sure my clients are going to react to this. And so I'm going to stay on the sidelines, and I'm going to stay over here, and I'm going to either wait for sufficient numbers of my clients to leave, or not see the growth that I was expected, which is very difficult to measure, because I don't have this. And also if I did have it, let's say if like a major, let's say if like one of the major data providers that everybody has the same news and quotes tools on the desktop today, or the major accounting systems or rebalancing systems or custodians in the world start to offer ESG data to me, what is it that that data can do to help me to either convince clients to consider impact investing or to expose some of the themes, or additional tools and capabilities that would help me to begin to tell a story. I think there's a lot of, I think a lot of what's not happening in the market is client demand being accurately translated into something an advisor can take action on or find a solution to help that client with. It almost feels like it's people are waiting on both sides, either be told that they have it or ask whether they want it. It's not happening. And I'm just curious if anybody can see if I can think of a couple of things like going to the grocery store. Actually, investments is great, but a lot of our current day-to-day decision making on what we purchase, where we vote with our dollars, is probably another area. But I don't know if anybody else has any new or novel technologies or emerging ways that humans can get connected to their exposure to their world, and how their actions, including investing, can be tilted to more benefit or to more align with their values. I don't know, Jay, if you see anything like that in the market.
I mean, obviously, I'd talk about us, just because selfishly that's exactly what we do. So full disclaimer there. But when you go to the doctor and they tell you you got like an injury and they tell you to do this stretch, and you go home and you do it and you don't really feel it, and then you start to hurt again. And that's a terrible analogy, and forgive me for that. But if they explain why you should do it, if you're part of that process and you're taken along for the journey, you're much more likely to do it. Right. So if a client comes in and they say, well, I care about this, and your portfolio gets transitioned to a completely impact portfolio, but you weren't told why, or why Peter's strategy is so interesting and why Tim's strategy uses so much interesting data, then the client's not going to be taken for the journey. And what we see, which is really interesting, is I'm sure, especially Stephen's very aware of the generational wealth transfer, right? $30 trillion flowing to the next generation of wealth in the next 30 years, the biggest generational transfer of wealth in history. Well, if you're a CIO or a multifamily office, how are you proactively engaging with the next generation of wealth to ensure that they stay with you and to ensure they're engaged in the conversation when the chart's been going up and to the right their entire lives, right? So starting from scratch with that next generation of wealth by saying, hey, let's actually figure out what your value set is. And by having that conversation, giving them something that does reflect that conversation, they feel connected to that CIO, to that multifamily office, they feel heard, while the investments they're actually being given provide them the same exposure, either on the venture side through Peter, on the public equity sides like us. So for us, it's about helping people understand what this conversation is about by starting from scratch and saying, what are your values? As opposed to saying, here's a bunch of product that kind of fits and your portfolio is clean now. You're not as bought into it. So for us, it's about, we call it building a mission statement. And you start from scratch and you actually have a deliverable mission statement that becomes a mechanism to define the values going forward that continues to evolve. So that's been a big feature for us in connecting with that next generation of wealth, preparing for that transfer of wealth. Does that capture the question?
Absolutely.
Yeah. And so Doug and Jay, just to add to that, so I feel like spend all my time speaking like 3 different languages with different generations. There are some people who I really don't need to convince, and they're sort of like my generation, a little bit younger and slightly older. I call them sort of like early stage Gen X. Then like the sort of early stage Gen X to late stage Gen X to like early boomer, and then sort of like between those periods. And then I kind of just think that everyone should be along for the ride. And so we're quite willing to speak very different languages depending on who we're talking to. I do notice there's a lot of cognitive dissonance, even when you are providing data and information. Sometimes people are like, I don't know how you make money. And I'm like, here's our IRR. They're like, I just don't get it. I'm like, okay, well, this was the last up round that we had from the other company, and this was the follow-on financier, and this is the valuation based on the traction and all the financial measures. They're like, I just don't get it. I'm like, okay, so you're going to have some of those conversations, and then they're, as long as you're trying to meet them halfway on the more traditional ways of engaging your client, then potentially they have the ability to stick with you if you're an advisor. And then I do see within family offices with my friends who, are working with their parents in a variety of different ways internally, how they're also engaging one another in that process is super important. And like also getting involved if you're an advisor and trying to understand, particularly if you know about impact, right? And you're trying to have distribution across your client base. It's going to be a very much a multi-generational and intergenerational conversation that you have to have.
Outstanding.
Was your question partially around how does it get to an owner of a smaller amount of assets? Is that what you were getting at? How does it become more generalized?
Less that. Now more like in a really brute way to think about it is ESG bought or is it sold? Is it something that people are asking for? And if they're asking for it, is there a way for technology in our general atmosphere, not just with investments and reporting, but in terms of daily life of that client? Is there a home for technology to help show mirrors, plural mirrors, back to society that help them to individually make better decisions that lead to putting their investment dollars into firms that align with their their behaviors. Because if you believed in it already, you likely found an advisor to help you do that. That's what we moved advisors personally 3 years ago to one that was much more focused on reflecting our values in our portfolios. We did that 3 years ago, but we went to that firm because they did it, not because we liked them. And oh, by the way, they also did it. So finding technology or having a home for technology that allow people to see it. I think maybe to Jay's point, like, be part of that journey, and that journey may start with 1 or 2 steps for every client out there. It could be that the CFA Institute in 2 years has a mandate in the States that says, actually globally, all investment policy statements should have some sense of impact question. What a freaking great idea that is, right? Like, let's put it on CFA Institute that everybody somewhat needs to comply to, that we're going to have a mandate that you have to ask all your clients one question about their desire for impact. Phenomenal, right? Then technology is chasing and everybody's chasing it. Barring those things, it's very difficult for people that may be interested in it to even know that it exists, because the people that are surrounding them, the technology they're currently using, none of it reflects any of this.
So I agree with that, but what I would say is that we're dealing with different regimes in different countries. So in Australia, you don't get a superannuation mandate if you cannot report consistently as a manager with ESG data, your ESG returns. You just can't, and make the narrative. In the UK, I think the legislation was introduced where the public pension funds are required to consider more than just financial return. In the US, we're not there. There's still the argument between the whole thing around you have a fiduciary responsibility and it has to be financial return first versus the social impact components. And that hasn't stopped us from being able to include the social components, but I think that we're somewhat behind here. So your idea around the CFA Institute or whatever body is actually a really interesting one. And I think that technology is going to be crucial. The reporting of performance in a way that demonstrates that you can have both financial return and social impact is what I think will actually drive the money. And Peter's right and Jay are right that it's about what the client's desire is and what their purpose is. But that's at different points of understanding in different clients, and that's highly customized. So if we really want to move the money, we have to have something that's more consistent in terms of how the returns are shown, and that people believe in the integrity of the information that's being provided. And I think we've got a long way to go on that front.
I could not agree more.
On that point. Tim, I think you were talking about the UK. At Beta, we've been working on client profiling and suitability profiling for just under 20 years now. And we've always had this mantra of establishing a common understanding between the advisor and the client in terms of risk. And over the last year, we've taken that forward into the area of, if I can call it, sustainability investing, social investing, whatever we want to call it. And it's been a very interesting journey because at one end, especially in the sort of the wider private client market, what you don't want to do is have the client over-constraining a portfolio. But at the other end, you want the client to be able to say, I'd like it a little bit greener. And then being able to translate that into something that you can quantifiably demonstrate that you are a little bit greener. So we've worked through that in creating a multi-tier process so that you can actually, on a consistent way, capture the client requirements all the way down to something very specific. On performance, we've worked with our partners, First Rate in the States, to actually look at how we can attribute performance to factor bets, basically. So if you've got a tilt on your portfolio, let's keep it simple, you are taking various ESG factor bets by doing that, and can you then attribute performance to those individual bets, which is then giving you performance attribution to your utility for various factor preferences. So I'm lapsing into quant now, Doug. So you better stop.
That's good. I'm going to go to, if with the permission of our panelists, we have a number of questions, and so those on the phone, on the video, We're going to spend the next few minutes answering some questions, but Johannes has been fantastic. There's one of our participants asking fantastic questions all along. We've been trying to weave those questions into some of our own questions. But one of the questions that Johannes has, and I'll just ask all participants, if you've got questions for our panelists, now is the time to type away. But how can technology and data reduce subjectivity and investor bias, especially in this area? I don't know if, Jay, do you have a perspective on that?
Sorry, you broke up for a moment there. What was that?
Sorry, mate. So how can data, ESG data, reduce the subjectivity of investor bias?
Reduce the subjectivity of investor bias. I mean, I think that using multiple data sets is a really important part of our process. So we're not just relying on a single central data set, and we're not relying on their scoring. So number one, the subjectivity of the score, which is the provider saying this company is good or bad based on what we believe to be the sustainable factors that matter most, and creating a taxonomy of importance with that. Actually ignoring the score and looking at the raw underlying data, but then doing that across data providers means that instead of looking at the subjective interpretation of data set from one provider or multiple, you're actually looking at multiple data providers and looking at the raw component data and using that to inform what you believe to be good or bad based on which factors you believe to be the priority. So that's the methodology that we've used. And when we founded the company 4 or 5 years ago, we did so with the belief that really high quality data around sustainable factors was going to continue to proliferate, which 3 or 4 or 5 years ago wasn't necessarily, agreed upon. But what we've seen is amazing data start to come out around all these various factors. So you create a bedrock of data from the major providers with the raw component data, but then you supplement it with really interesting issue level data around things like private prisons or fast food and advertising to children, and just these component things that really resonate with people. So you have a bedrock of less subjective data then supplemented with issue level data that's really interesting and exciting.
And Jay, just to that point, we have another couple of questions talking about that bedrock data, right? The standards that are required at that bedrock data level. With new technology coming in, machine learning, scraping information, just pumping more and more data into the industry, that doesn't necessarily help, right? More data is not necessarily good. The standardization and being able to rely on it and then correlate that data with some level of validity to outcomes or themes. How do we get there? Like, how do we get to a standard set of data that folks can rely on? I mean, a price, even today, regular liquid market, the S&P doesn't always match pricing source the pricing. The S&P's price for a bond can be vastly different than someone else's pricing for that same day. In an industry that's been pricing stuff for hundreds of years. So in our new world, how do we get there? How do we get to a standardization like that?
Well, fortunately, I work with vastly more intelligent people than myself, who have a lot more ability on the quantitative side to do the level of research. And ultimately, it just comes down to doing your homework, right? Not all data is created equal. Not all providers are created equal. So for us, it means constantly doing a re-review of the sector, of the available options. And that's actually what a lot of our team does very frequently, is say, okay, well, let's reconsider this provider. They've added this data set. Let's reconsider our existing data providers and see if they're still maintaining the same level of standards. And so that's the best that we believe we're able to do. Fortunately, we're also very well capitalized as a venture-backed company. So we have the ability to spend the necessary financial resources on the data sets that we believe to be the best. And that's what allows us to do that. So it's just, I think, constantly doing your homework to determine what the right and the wrong data is for you, to the best of your ability, because, the search for perfection is going to stop assets flowing here, right? So understanding that there is no perfect answer right now, but we can do the best we can.
Awesome. Thank you so much. And for the rest of the team, we're at the top of our hour. We commit to wrapping on time here. Thank you to our panelists. This has been a fantastic conversation. Stephen, you want to take us out?
Yes, please. I'd just like to thank you, Doug. That was really excellent, very well moderated, and what a great panel. Thank you, Peter, Jay, Tim, and Daryl. That was fantastic. A compelling discussion, lively, detailed, and specific. I've learned a lot. I'm sure the audience has learned a lot as well. So thank you very much indeed, and goodbye. Thank you.